Okie dokie. Okie dokie, everyone. Can I just say, first of all, a very good evening, or a very good afternoon, or a very good morning, of course, depending on where you are around the world. First of all, I'd like to thank every single one of you for joining me tonight for tonight's little webinar. I hope you'll find it extremely informative and useful. And in some ways, hopefully, you also enjoy a little bit about it. Anyway, for tonight's webinar, it's a continuation of the series I'm running called How I. And tonight's episode, so to speak, is called How I Started to Learn About Support and Resistance. Written by myself, of course, who's the trading educator here at Stratton Markets. But before I get on to a full-blown, obviously, introduction on who I am and tonight's agenda, of course, we're talking about CFD trading and online trading. So clearly, we have to make sure and establish, be aware of the risks involved, because like with any type of investment, online trading is extremely risky. So I do suggest you do your own research and due diligence and know the risks involved before entering any trade. Now, with that out of the way, this good-looking chap here is yours truly. Like I said, my name is James Truskothick, and I'm the trading educator here at Stratton Markets. I have over 20 years of experience in the financial service industry. I actually started off at the young age of 18, and as you can see from my picture here, this hairy, wrinkly person, I'm now in my 40s. I actually started off, like I say, when I was 18, in the mortgage industry, where I specialized in commercial mortgages and buy-to-let investments before moving into pensions and unit trusts, etc. And then I moved into, obviously, the online trading arena, where I have indeed, of course, obviously got trading experience myself. I traded through Dubai Gold and Commodity Exchange. I've also run a floor in the Philippine Stock Exchange. Before I moved into sort of portfolio management for several large Forex firms, before sort of moving into sort of the round of education and sort of sharing a bit of my experience. I'm indeed a published writer, and I've actually been published in several leading industry publications, including the Financial Times Advisor, The Street, Market Watch, FX Trader magazine, and the City AM newspaper in London. And I would say I'm also an avid market commentator. One of the many things there is about me, I'm extremely passionate about the markets and about this industry. I'm also a well-known public speaker, and I've spoken in several larger sort of industry events around the world. And, you know, occasionally I do like the sound of my own voice, but don't hold that against me. Now, though I'm indeed a trading educator, what I will say about myself, I will never, ever call myself an expert. Because personally, I don't believe anybody's an expert in this industry. However, I have got a good rounded understanding and knowledge, which I hope to share with you as much as possible. And at the same time, I'll share with you, you know, my passion, etc. Though I will express opinions every now and then, this whole course or this webinar is purely for informative purposes and for educational purposes. So please use this as a foundation for you to carry on with your own studies. Now, tonight's webinar, like I say, is called How I Started to Learn About Support and Resistance. So, of course, that means we'll be talking about what support and resistance actually is. At the same time, we'll be talking about calculating pivot points and support and resistance levels connected to those pivot points. We'll also be talking about technical indicators to find the support and resistance. And we'll discuss how some traders trade using support and resistance levels before wrapping up to up and coming educational events and obviously a question and answer session at the end. So what is support and resistance? Now, support is a level where an asset could fall to and the market starts to buy in again. It's like a level. Acts a little bit like a trampoline. So something's falling. It hits this certain level, this sort of price range. The market jumps in, starts to buy it up again, and it then shoots up higher. Okay, and so it shoots up higher. Resistance is the opposite. Resistance is a level where an asset could rise and the market will start to sell from. So basically, it acts like a ceiling. So an asset could be rising, hits this particular level, and then the market jumps in and starts to sell that asset, and the asset price starts to fall. Now, traders study support and resistance levels to engage potential entry levels or to use them as a stop loss or take profit levels. There's a pretty little diagram there, look. Now, at times when either a support or resistance is indeed broken, they can change roles because look, the support and resistance, they're not there forever. Okay, they can change. So what tends to happen is that if it is indeed broken, either the support and resistance, they sort of swap their duties a bit. So the support becomes the resistance and the resistance becomes the support. Now, some of the many things you'll find when you're trading and when you're talking about it, people will talk about pivot points and support and resistance. Now, pivot points and support and resistance connected to those pivot points are basically calculations. And what you do is you simply take the last session's highest price, the lowest price, and the closing price of a selected asset. Now, as we've mentioned, this market is 24 hours a day. So most people who calculate pivot points, they tend to take the price of the New York close, which is around about, excuse me, it is, I can say, yeah, 5 p.m. New York time. Now, this is the calculation. Now, what's important here is the pivot point, okay? Because then you can base the pivot point and you can use that pivot point to calculate the support and calculate the resistance. Now, the pivot point, or simply abbreviation PP, is you take the high, you take the low, you take the close, you add them all together, and you divide them by 3. Excuse me. Divide them by 3. Now, to calculate the support, what you do is you get that pivot point, okay, the pivot point you've just worked out, you times it by 2, and you take away the high. To get the resistance, you get that pivot point, times it by 2, and minus the low, and that will give you the resistance level. So to give you just a rough example here, okay, this is just an example, just some numbers I took from the Euro-Dollar daily chart a little while back. So the high of the session before was 1.1533. The low of that session was 1.1411, and the close of that session was 1.1438. I added those 3 numbers together, divided by 3, and it gave me the pivot point of 1.1460. To calculate the resistance, I then had the pivot point, I times it by 2, and I minused the low, which is 1.1411, and it gave me a number of 1.1509, and that was the resistance. And for the support, I took the pivot point again, times it by 2, minus the high, and again, it gave me the potential support. I should say support, not low. Now, the theory is, if an asset is trading above the pivot point, okay, then the trend is bullish, apparently, in the theory. If it falls below the pivot point, then that actually says that the trend of that asset is bearish. In the same ways as we calculate the resistance and the support by timesing it by 2 and minusing the high or the low, that pivot point also acts as a resistance and a support. So if it's trading above it, points and support and resistance connected to those pivot points. Now, finding support and resistance, it's not just pivot points. There's several technical indicators you can use at the same time as well. Now, channel lines. This is one particular theory, and this is really you can use the naked eye, is where you can look over a period of time and you can see basically where an asset's been trading in between 2 levels, where the market's been selling from and where the market has been buying in from. Now, as you can see, excuse me again, sorry about this. As you can see, obviously, that there has been acting as a support level, that channel line there, been touching that and bounced back up again. And during that time, it's also be acting as a resistance, touching it and falling back down, acting as a support there, acting as a resistance there, acting as a support there, acting as a support there, acting as a support there. But then it breaks, and for a small period of time, again, like I say, support and resistance can change roles. It swaps its roles and it acts as a tiny little bit of a support until, again, it finally breaks it again. And again, the support level starts acting in there. As you can see, sort of trading between the range. And again, it acts again as there is quite a poignant resistance on that asset there. Eventually, of course, it does indeed break, and it then swaps roles and becomes the support. I'll give you another example. Now, this is again on a daily chart. Okay, we can connect the lows and the highs there. Okay, with our level there and the highs there. So we can see initially that level was acting as a resistance and it was holding that asset down. Eventually it broke here, and we had a new resistance level, and it then changed its role and then became a support. So you can use channel lines to try and identify support and resistance. You're going to use exponential moving averages, which is a technical indicator. The theory is if the asset is trading below the exponential moving average, then it's on a downtrend. And that means then, if it's trading below, that moving average level acts as a resistance. The theory then goes, if it breaks above the exponential moving average, it's in an uptrend, and that exponential moving average then starts to act as a support. And as we can see, it was trading slightly below it, and it held up as a resistance till it broke on a slight uptrend here, and then started to act as a support. Again, it broke under, came under, held under for a little while again, acted as resistance before breaking again and acting as a support. This is a daily chart, by the way, ladies and gentlemen, just so you know. Then, as you can see, it breaks below the moving average, means a downtrend. So the exponential moving average, which is easy for me to say, becomes a resistance. And as we can see there, it acts as a support and resistance and keeps changing its role as soon as the asset is underneath it or above it, etc. Fibonacci retracement. Now, Fibonacci retracement is a very famous indicator. It's used by several people. And Fibonacci retracement is actually very good to use when you have an asset which is actually on a uptrend. Okay, an uptrend. Now, what you do here is that you link the beginning of that trend, so the bottom of the trend, and you link it up to the high of that trend. So funny enough, when I was thinking what to, what instrument to show or asset to show you, which has been on a steady uptrend for a long time, I suddenly thought, well, the perfect one is the S&P 500. So obviously the S&P has been on quite a bullish trend for quite a while now, along with quite a lot of the stock market. So you link the bottom with the top, okay, and then what you'll see, it gives you several numbers, several levels, okay, and the important ones are 61.8%, 50%, and 38.20%. Now, the theory behind the Fibonacci retracement is that when you see an uptrend, by using the Fib retracement, it gives you an indication of a potential support level for which you can then buy in again and rejoin the trend. Okay, so record the retracement, obviously, because retracement, it falls back down before it starts going back on its trend again. And as you can see, these key levels have indeed acted as a support. It's come down and it's touched and it started to move up again. The same with the 50%. It came down and the market started to act like a support. But more importantly, the 38.20, when it was on a big retracement, indeed acted as a support, and the market has started to buy in again. So Fibonacci retracement tends to be a very useful indicator to potentially spot an entry level when there is something on a steady trend, either an uptrend or a downtrend. It could also be used as a downtrend as well. Bollinger Bands. Bollinger Bands is another popular technical indicator to be used for spotting support and resistance. Tends to be a lot more useful during times of when the market is ranging. Okay, you can tell when the market is ranging, when the volatility is slightly lower, it's because the bands are less tight together, as you can see here. And the theory goes that if it's trading between those two bands, the top band will act as a resistance and the bottom band will act as a support, as we show here. Okay, it's touched upon a band, the market started to move up again. Okay, and then as we go across again, it touches top band and the market starts to sell. Bottom band, market starts to buy in again. Bottom band, the market starts to buy in again. And as you can see here, we've got a steady tight range when it's trading between those two bands. When they're very tight, means the volatility is less and acts as a support, resistance. Now, one of the theories some traders do, okay, when they're trading with Bollinger Bands, is they try and they take profit round about the middle bar, which is the moving average, to try and lock in some profit. Because as you can see, at times, that middle bar has also acted as a resistance and a support, at times as well. So a lot of people tend to look at the middle bar to try and lock in some profit or to indeed set a stop loss, etc. Now, we discussed about how, support and resistance, how to use them, how to find them, and what they are. But let's discuss some methods of trading. With some traders use by using support and resistance. Now, first one is known as the bounce, of course. When you see an asset comes down, touches that support or resistance, and it bounces straight up. So some traders wait for the bounce. And when they see a bounce, what they then do is they enter in a suitable place, setting their stop loss slightly under what that level was, being, in this case, in this illustration, as a support. At the same time, the methods of trading support and resistance, there's another way. It's called the break. So that's called the bounce. This one's called the break. And there's two types of methods of trading on the break. First of all is called the aggressive. Okay, and basically, as soon as you see something penetrates the support or penetrate the resistance, that trader will jump in with an entry level, setting his stop loss just above it. That's aggressive. So there's no waiting back. Sees it penetrate, sees it breaks, it goes, right, it, I'm going in. And that's always one of the toughest theories, because the argument often is, how do you know that level was properly broken? So again, depending on your attitude to risk, this is the aggressive approach, and sometimes that obviously can help. If that's your type of method. So that's the aggressive way of trading support and resistance. The other one is on the break. It's called the cautious approach. And what the cautious approach does is wait for the level to be broken, but they don't jump in. What they do instead, they wait for it to retrace or bounce back again. And if they see it bounce back, and indeed then continue to fall, the theory is that support is now rolls and has now become a resistance, meaning that the market is indeed broken that level. So what they then do is they wait for that, wait for it to see it bounce back up, see if that support has then become a resistance, and then enter the market, setting their stop loss slightly above what was the support, which is now acting as a resistance. Now, there is some up-and-coming educational events coming up very, very soon. The 21st of August is a big one. It's going to be a very big webinar. Actually, we're doing it with FX Umpire as well. So it's going to be a very big one. And like I say, I've got a personal relationship with what I'm talking about. I'm actually doing, it's actually called How I Started to Understand Gold Trading. And like I said, I have got quite a close relationship with gold because I traded gold myself. It's actually the first asset I ever got involved in when I first started out in this industry. Just to show you what price it was. It was round about, when I first started, about $596 an ounce, something like that. So I remember it quite. I do remember it. I got a close relationship. So we will be doing a case study on how to how to understand gold trading. That's on the 21st of August. Then on the 28th of August, the final one for the month is how I learned risk management. If you wish to speak to me or have any questions, please feel free to email me at james@strattonmarkets.com, or indeed you can contact me or reach me at Twitter, on my Twitter, or indeed follow me if you like. Sometimes I talk about markets. Why not? My Twitter handle, of course, is at @jtruscothic. Plus, at the same time, like I always say, if you have any suggestions or any ideas of what you would like me to cover maybe in the future, or you have any suggestions of other subjects you'd like me to cover, please never hesitate to contact me by email or by Twitter. Because at the end of the day, guys, ladies and gents, we're doing this education material for you, okay, for your benefit, to help you with your knowledge and your understanding of this industry. If there's a particular area or particular subject you want us to focus on, please don't hesitate to contact us or contact me and let me know. Now, like I say, this again is being informative and educational purposes only. However, this has been talking about a risky investment. Of course, we're talking about online CFD trading. So I do suggest before you do anything, you do your own research and due diligence and know of the risks involved before entering any trade. And on that point, do I have any questions? Okay, that's a good question, Bob. The question is, how do you know when a level is particularly, or a level of support and resistance is actually being broken? That is a good question. Look, like I say, there's a grey area with this because there was never any real foolproof way of saying a level has definitely been broken. One theory is that if you see a candle open and close underneath that said support or that said resistance, that's a sort of a clear indication that indeed that level could potentially be broken. Plus, it could also be at the same time an indication similar to the break, the cautious level, that indeed that support or resistance has now swapped its roles, meaning that level has indeed been broken. Can I know how to use my stop loss or take profit using support and resistance? Yes, well, like I say, the idea is people use support and resistance to try and identify not only entry levels, but take profit and stop loss. Now, again, this depends on your attitude to risk and your risk management, where you set it. Some set it right on the level, but other people, depending on their risk management style and their attitude to risk, may set it maybe 10, 15 pips below it. To make sure that they're protected in case they do indeed see a bounce or a retracement or that level is not broken. So that's how to use it. Thank you very much. I'm glad you enjoyed it. Thank you. Any other questions at all? All right. Okay. Well, in that case, there's no other further questions. Okay. Excuse me there. Bit of a frog in my throat. Can I just say thank you so much for every single one of you coming tonight. I hope you found it informative and insightful. Don't forget the next big one, which is on the 21st of August, which is, like I say, how I started to learn about gold trading. Should be quite a useful one, a good one. And like I say, I'm going to be passionate about that one because I've traded gold myself and I have a special relationship with it. So hopefully I'll see you on the next one. So that leaves me to say, can I wish every single one of you, depending where you are around the world, a very good evening, a very good night, a very good afternoon, or a very good morning. Until next time, you trade safe.